Hey everybody, Catherine Castro-Eardley here with Radius Financial Group, branch manager out of Andover, licensed in Mass, New Hampshire, Maine, Connecticut, and Florida. I'm here with
Darnell Billings, real estate agent with Keller Williams, Boston. Not licensed in all those states that you are, but I'm just licensed here in Massachusetts, and born and raised too. So now
in
I feel
Boston.
less than because I don't have all those licenses like you.
Well, you don't need them because you have an amazing networking referral network within
True.
Keller Williams that
True.
sends you business and that you could send business to no matter where people go,
True.
even internationally.
Even internationally, like right now, I have a client that's flying to Dominican Republic, and I connected him with an agent out there through Keller Williams. So yeah, you're right.
Yeah,
I don't have to be licensed everywhere.
exactly.
But it just sounds cool when you say it, though.
It does sound cool, not gonna lie. I want more states just so I could blah 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 blah. You know, just so I could say them.
I got to come up with something. I got to come up with a new elevator pitch. Or
That's
something.
all right.
Maybe on the next video, I'll have something.
Yeah, you could make it happen.
Okay.
So what do we want to talk about today?
Well, let's talk about today as we go down this generational wealth path. You know, I think what we want to talk about is you're buying a second home.
Yeah.
And what does that look like when you own your first home, right?
Yeah.
So you have a home, you're thinking about getting a second one. I think if I think about this big picture, is like most people think that buying a home is the goal. Like that's it. Like that's where it stops.
Right.
But it actually is the first step on this path of generational wealth building, right?
Mm-hmm.
Now, if you already own a home, you're sitting on an opportunity, or you're sitting on some money, and the question is, what do you do next? And for a lot of people, the home that they own is actually costing them money
Mm-hmm.
versus making them money or
Correct.
passive income, as we might say. So I really want us to kind of go down this path of, I have my first home, I want to buy a second home. What do I do next?
Yeah. So I keep hearing the term house hack, and I've heard it from you, and I've heard it from other partners, and I see it online. And, you know, we also talk about, you and I always talk about like mortgage fraud and all this stuff.
Mm-hmm.
But there is the ability for you to buy a home as a primary residence. And let's say that first home is a multi-unit home, like someone like yourself who bought a multi-unit home first. They occupy it, and now they're ready to move on to the next one. The hack is that most people usually buy that first home either using a conventional loan, do it 5% down,
Mm-hmm.
or using an FHA loan and doing 3.5% down, right? So depending on, you know, where you are in your value in equity, meaning the difference between what you owe on your home and the value of that home, depending on where you are there, you might be able to refinance out of that FHA loan or out of that conventional loan for maybe some more attractive terms, if at the time there are those more attractive terms, so that you can take some of that equity out, some of that, you know, money out of your home and use it to put down towards the future purchase. Now, in this market, because most people, or a lot of them, you could say, bought when the rates were lower.
Like 2-3%,
Exactly.
4%.
Like, what's your rate currently on that mortgage that you had that first one?
About 2.75%, I believe it is.
That's going to be hard to part with.
Oh, absolutely.
2.75, like not only is your home making you money, but like you're almost living for free essentially, because the mortgage is so low on that house compared to, let's say, if you are buying that house today at 6 or 6.5%. That's a huge difference, right?
Mm-hmm, correct.
So you're making money, you're saving money, you're able to budget for repairs if needed. You know, there's so much that you can do because you buy at such a low rate. So we don't want to get rid of that loan. We want to keep it. So the first suggestion I would make to my clients is, first of all, let's sit down, because then I can do a full analysis of what's happening with the credit, right? Sometimes people have a low interest rate, but maybe they've accumulated some debt, or maybe other things have happened. So then I can talk to them about getting an equity line of credit. So an equity line of credit is a second loan that goes against your home, right? And then you can use that line to pay off debt if you need to. But if you don't have any excess debt, we could use that line to qualify you and use it for the down payment of the future home. Now,
Gotcha.
going back to house hack. something that I've heard from other professionals in the field and even some of my clients is they are married, but the wife has not bought. She's still a first-time home buyer. She has nothing to do with that home, either whether because they weren't married when the home was bought or they made the decision to accumulate assets on their own as individuals, right? They file separate. It's called married filing separate. Some people do that. I used to do that with my spouse because of student loans and all this other stuff, but nonetheless. So if your wife or your spouse has, or your partner has not purchased a home, they could buy as a first-time home buyer. The intention is that if they're going to buy as a first-time home buyer, that they're going to live in that home. So you, let's say you, the person who bought the multi-unit, the intention is that you're going to move in with them. You can do that. You just should look at what are the restrictions that are on your first loan that you use to buy your first primary residence. So if you use down payment assistance, does that have additional restrictions that you should concern yourself with? Some of the down payment programs do have restrictions that if you use those funds, you have to live in the home for 30 years. So that's the kind of stuff to pay attention to. But let's say that you just bought with a regular loan. You never used any down payment assistance. The restrictions for some of them, like FHA, might be that you have to live there for a year. And again, as long as you didn't use additional funds that were down payment assistance funds, that should be the restriction from FHA, which is a year of occupancy before you move out of that home. And now, if your spouse is buying with a conventional loan and they are putting down 5% with the conventional loan, you can move in with that person. That's still your spouse. There's nothing keeping you from doing that. Now you've built wealth, right? Because now you are no longer occupying that second or third unit from your multi-unit that you own. You're receiving rents from both of those units. And now you're moving into the future home with your partner, right? Mm-hmm. They're also accumulating rent and you're building wealth faster, right? Because I never want to say there's a wrong or right way of doing it.
Right.
I know people like myself. I didn't feel comfortable having a multi-unit because my concern is like, I don't know how to deal with tenants and I don't have a lot of energy or time to do it because I have 3 kids and there's all this other stuff going on. So at the time, my decision was to buy a condominium versus buying a multi-unit. Now, some people would frown upon that, but that's what worked for me. That's what I felt comfortable with. So until I feel more comfortable with having more responsibility or maybe feeling comfortable with spending the money for hiring a management company, which you can do. You can do that now. You can hire a management company to manage your tenants for you, collect rent and do repairs and different things like that. Obviously, there are fees attached. But if you do that, essentially, again, you're still in a good position. No investment is a bad investment. I would say if you make no investment and you pay rent, that is a bad investment.
Okay.
That's kind of the way I look at it. Obviously, if it were a multi-unit, you build wealth faster because the idea is that you're going to be collecting more than enough rents to pay for your mortgage, the equity that you took out, right, to put the down payment on the new house, right, if you went that route, if you needed to help with the 5% down or whatever the number was, the equity that you put down, right, you're going to need to pay for that equity line. You're still going to have your first mortgage on the other house. So the idea is that between all of the rents that you're collecting, that all the mortgages are paid and that you receive excess cash. So when you're looking at these houses, what do you think that you should be doing as a buyer? What would you advise your client as an agent?
Depends. Ask me the question again in the context. Okay. As you're talking, my mind is like going so many different ways.
You're like excited. Okay, so here's the way I would put it. So let's say I'm your client, right? Mm-hmm. And I say, Darnell, I have this multi-unit house that I own right now.
Yep.
I'm ready to buy the next multi-unit house. Let's say I have a 4-unit. I have a 4-unit house right now. I'm really looking for a 3 or a 2-unit that's more comfortable for me and my family and that there aren't so many tenants living in the same space as us. So now I say, Darnell, I'm ready to buy that 3-unit house. What is your advice to me as I'm looking at properties? Are you going to say, hey, maybe let's make sure that these rents can cover the mortgage. Let's make sure that you're actually going to make money off of this. Are there leases in place? What are those leases? Like, what are the different things that you advise your clients?
No, I mean, you hit on a lot of it, because when I advise my clients, I'm really advising them how I would advise myself on when I'm looking at to buy another property. And so you're right. I'm looking at the area that the property is going to be in. How much is it going to cost? What are the repairs going to potentially cost for this type of property? What type of tenants do they have? Is anyone behind on rent? Has anyone been taken to court? Looking at the cleanliness of the property, the cleanliness of the tenants' units, and looking at how much we can get for rent versus how much is being charged for rent as well too. And a lot of times when I look at rents, I look at what Section 8 is charging in that area for rent. So at least I have a baseline of to say, okay, at the very least, if I was renting to all Section 8 tenants, here's what I could probably charge for this property. So when you're walking into a lot of these multifamilies, if you're looking to buy them, it's really trying to figure out, how do I make money from day one? You really shouldn't be buying the property with a thought that I'm going to be losing money as soon as I buy it.
Right.
Right. And some people have that mindset, and that's a different game plan that they may be running.
Right.
But for most of us, and how I advise my clients is, we got to be making, the property has to make money for the most part.
Right.
Your single families generally aren't going to make you money because you have to work in order to pay that mortgage.
Mm-hmm.
Your two families or your duplexes necessarily aren't going to make you money either, because as long as you're living there,
right, there's only one rent that you're collecting. One rent
that's helping pay down that mortgage, so you can keep a little bit more in your pocket.
Mm-hmm.
And then the three families, you can usually put some money into your pocket, and then your four families, you would definitely start cash flowing and put some money into your pocket.
Mm-hmm.
So then let me ask you this then. If I own my property today, how long do I have to wait before I could buy that second property?
Well, it depends on the type of loan that you got. It goes back to my first statement,
Mm-hmm.
which is, if you bought with just a regular conventional loan or a regular FHA loan, with FHA, there's the restriction that you should be waiting at least a year.
A year.
Right?
Okay.
With conventional, there's no said restriction, but most people wait 6 months to a year before they make a change.
On conventional.
Yeah.
Okay. So in theory, if I have an FHA loan, then I only have to live in the property for that 12 months, and then I can move out and rent it.
Correct. But there's also like a mileage restriction. So for example, let's say you have that one property with FHA, you're not refinancing it out of an FHA loan, and you're now looking to buy another property in your same town or
Gotcha.
2 towns away. You have to be 100 miles away from the original purchase with that FHA loan before you're allowed to use another FHA loan. So if you're going from FHA to a conventional loan, they don't care about distance. That's not a concern for the conventional requirements. But it would be a concern for FHA if you were purchasing with another FHA loan, right? Because their idea is that benefit should be used for a primary residence, for someone who really needs those flexibilities around the 3.5% down payment, the 3 months reserves, anything over a 3 unit, the flexibility on the credit scores, etc.
Okay, so for instance, since in Boston, so if I have that FHA loan and then I want to go buy my second property, I'm just using a conventional loan at that point.
Mm-hmm.
And then how much am I putting down?
So that's 5% down with the conventional loan and 6 months reserves.
Is that
that's conventional? That's for a conventional loan.
Does it matter if it's a single, 2-family, 3-family, 4-family?
It doesn't matter. If it's well, yes, it does. Excuse me. If you're buying a single family, there's no reserve requirement unless they are, for some reason, because, we have to remember that sometimes, depending on your credit history and different things that may show up.
Okay.
It could be a situation where you're just buying a single family, but maybe ask you for 3 months reserves for the other property that you have, not necessarily for the one you're buying.
Mm-hmm.
But at times that can happen depending on the credit history. But usually for a single family or condo, even a 2-unit at times, it doesn't require reserve, even if you already own another multi-unit home.
And what is reserves for the people that don't know?
Perfect question. Reserves are essentially a number of payments for your principal, interest, taxes, and insurance, and PMI if it applies. So let's say that I say 3 months reserves. That means that you need to show us that you have saved either in a retirement account that can be accessed to take those funds out. See, the Spanish came out there. I couldn't figure out that word, how to say it. But basically, you would have to show us that you have those funds in an account. Again, not going to be used, but in the case of an emergency, that you can access them to, keep yourself out of foreclosure.
And for reserves, who makes a decision on how much reserves that I should have? Is that a Fannie Mae,
So
Freddie?
Fannie, Freddie, and Ginnie. So if you're going with a government loan, we're looking at Ginnie Mae underwriting guidelines.
And we say government loan, we mean
FHA,
FHA.
VA, USDA.
Okay.
If you're going with a conventional financing loan, right, you're looking at Fannie, Freddie guidelines, right?
Okay.
So essentially what happens is there's some flexibilities that Freddie gives that Fannie doesn't, and vice versa. So again, it goes back to that individual's profile, almost like a DNA, like how's the credit history, like all these little things can trigger certain requirements. So we run it through their underwriting system first before it sees an actual human underwriter. That underwriting system, or what people would call AI now, we've been using this for a year, but it really is AI. It looks at the requirements of the guideline, and then it looks at the profile of the loan or the application you're submitting, and it will tell us automatically, oh, this application requires this, and then it gives us the reason why. It would even tell us if we needed to collect tax returns or not. Sometimes it comes back and it'll say, you know what, we don't need tax returns, we just need the W-2s. It might tell us if we need to verify employment with an employer or if we don't have to. It might tell us if we need 3 months reserves versus 6. It might say no reserves. Again, it really gives us a detail or a roadmap of what we should be collecting and what we can do for that individual.
Well, so thank you for that. So now I have 2 questions, because I always hear, so credit score. Is there a certain credit score that a buyer should have when they go purchase their second home? And then the second question is overlays. I've heard this term overlays used a lot. Overlays, where, ABC Bank says that, I know what the guidelines said, but we're going to overlay the guidelines and add on some more restrictions or requirements.
Yeah. I mean, you tend to see that more, like you said, banks, right? Not independent mortgage companies or direct lenders.
Like Radius Financial.
Correct. So
nice
we
plug
usually, there, right? Well done. We usually will do underwriting based on the guideline, right? So we put it in the system. We want to underwrite to, like I said, I'm going to look at that form. We're going to review it. Of course, there's going to be a human being who looks at your file. That's an underwriter. And them, he or she, they will review that document and then also do their, like actual human being, not a computer, take a look at what you've presented and, do an overview. They're not putting on overlays. I have worked at banks and I have seen that where, they offer a product, but maybe the bank isn't comfortable going over, like, for example, the debt to income is a big one. With Fannie and Freddie, I've underwritten loans up to 47%, even 48.
And what's debt to income?
Debt to income is your total expenses on a monthly basis, including the future mortgage, against your gross monthly income. So that's a percentage.
So when I get a paycheck from my job, it says, is it gross pay or is it the net pay?
If you're a W-2 employee that receives a paycheck, it's your gross pay.
Okay.
So we're approving you based on your gross pay if you're a W-2 employee. Now, if you're a contractor, 1099, or you own a business, we're approving you based on your net income after your deductions. Very different.
That is very
more
different.
Strict.
Because when I started out in real estate, everyone's like, yeah, you're a 1099, you're a real estate agent, you could write everything off. Yeah. And I did that the first year I wrote everything off, right?
Yeah,
because I legitimately wrote everything off.
Yeah.
And then when I started to go down the home buying process, they were like, yeah, you don't make any money. I was like, what are you talking about?
Yeah.
I sold X amount of dollars this year. But they're like, yeah, but you wrote everything off. And, if you're walking away with $10,000 a month, in the year.
Yeah.
So
if you're netting $10,000 a year, you're not making any money
so
on
that's
paper.
A good point. To all the 1099 employees out there, all the real estate agents out there,
all our business
owners, if you're planning to buy a house, within the next year or two, please make sure that you don't write off everything to expenses.
But here's where it gets exciting. If you do that, there are other products. For example, again, it goes back to, are you working with a bank? Are you working with an independent mortgage company? Are you working with a direct lender? We have what are called non-qualifying mortgages, meaning non-QM mortgages. These mortgages that don't fit all those other mortgages I just mentioned that allow you as a business owner either to buy as with a bank statement loan, meaning that your bank statements show the income of your business coming in consistently on a monthly basis for 12 to 24 months, that we can calculate your income based on that. Doesn't matter what your taxes say, we can do it based on that. That's called a bank statement loan.
Okay.
Then the other option for someone in that situation is called a DSCR loan. Right? It's a debt service. I always say credit ratio. I know it's not that, but it's okay. I'm going to say credit ratio. I'll fix it in the comments. That's how I have it in my head. It drives me nuts. But if you use that product, what happens is now the property qualifies itself. It is not qualified based on your debt to income or your income as an individual. I mean, meaning as a business owner, you're qualifying based on whether the property could pay for itself or not. So let's say that you go out there and you like this 4-unit home, but again, you're that business owner who showed too little income.
Right.
You now can say, okay, you know what? That mortgage is going to be, let's say $6,000 a month. As long as your mortgage payment and the rents being collected, if the rents being collected exceed that mortgage payment, fantastic. You can move forward.
Current rents or market rents?
It would be current rents if there are leases in place. So now, again, you, the real estate agent, like you said before, you're going to be asking those questions. Hey, what are the leases in place? What's the market rent? Let's compare them. Does this make sense? That's essentially what that product does. But for an individual who's a business owner or a contractor, right? Same thing, kind of the way you're filing is very similar, that you can still move forward even though you don't have that high, bottom line number that you need to qualify with a regular conventional loan. So I think for me, and I think we've talked about this before, because this is how I work. Not everyone works like this. If I can't do something, usually I'll say, you know what? Try with someone else. There may be something I can't do that they can do. In the past, when I worked for banks, that's what I had to do because I couldn't help all my clients. Now I offer more products, and it has made a huge difference for my clients. Even for my clients that had already bought with me, I have a guy who owns a body shop, quick fix business. It's really cool. He has a van. He goes to your house. He fixes dents. He has a lot of income that comes in monthly, but his taxes just don't reflect it. So what we did for him was we showed him the option of refinancing that same loan for him, but with that loan, with the bank statement loan as a business owner. Because he occupies that property. So
then 2 questions. So what credit score should a buyer have when they go to purchase that second home? Just regular, nothing fancy. And then whether I have a single family house or a multifamily house, how do you use rental income to qualify me to purchase that second home?
Yeah. So first answer to the credit scores. So FHA can go as low of a score below 580. Keep in mind, the requirements will change. If you're below 580, they ask for a higher down payment.
Okay.
Right? If you want to go conventional, technically, the credit requirements have been removed. It used to be 620, but you have to get an automatic approval through the system. So it's very rare for me to see a 5% down with a much lower credit score than a 620 to get automatic approval without it requiring that person to put more money down. So now we're maybe looking, instead of doing 5% down, maybe we're looking at 10, or maybe we're looking at more reserves. So it can change depending on that credit profile.
So if you want to buy a second home, you really want your credit score to be over 620.
You want your credit score to be at least a 580.
Oh, right? That's basura.
Well, I
a
mean,
credit score that
but this happens. And honestly,
It does,
sometimes
but-
it happens to good people. It doesn't mean that they've done something wrong. Sometimes I've met people that have had their identity stolen and they can't
True.
control that. And they're trying to
True.
fix it. But no matter how much effort they've put into it, it's just taking a long time.
it's just it just involves a little bit more hurdles at a 580.
Correct.
But
More
theoretically, you want to be at a 620 or better
hurdles. Right.
to make things kind
For
of go
sure.
smooth.
And then when it goes to the investor loans, the DSCR loan, and then the
Yeah.
bank statement loan as a business owner, you definitely want to be a 640 or higher. The
Gotcha.
higher credit score, the better the terms are going to be.
Gotcha.
Period.
Okay.
And that applies to most loans when it comes to the credit score. One thing I want to talk about, because this came up for me with a client very recently, is
Mhm.
he had an 815 credit score.
815.
815.
How did they go? 830? Is it 830?
850 is the highest.
850.
So he was really excited because, you know, he had been working on his credit for a long time. And I felt like the bad guy because he thought that your approval amount was based on your credit score. Your approval amount is based on your income, your ability to repay. Your credit plays a factor, but it's more of a factor when it goes into what product could be used and also what your interest rate ends up being.
All right, so let's break that down one more time. Just so the pre-approval that you get on a mortgage is based off your debt, your income, a little bit of your credit, and then one more thing. I thought there was one more thing.
Well, it's
It's
a
just
lot.
really debt to income.
Yes, but it's a lot
And
of
credit.
ability to repay,
Okay,
right?
yeah,
Your
yeah.
ability to repay has to do with your income. Can
Okay.
you afford to pay the loan back? Like
Okay.
in the next 3 years, are you going to be able to afford to pay this loan back?
Gotcha.
You know, we have to prove ability to repay, but your credit score, you could have an 850 score, but if your income is too low, you won't be able to qualify for much.
Gotcha.
Right. And then
Okay.
if you don't have any assets where you could do like a bank statement loan, right? If you're a business owner and you're not able to do a 20% down or even a 15% down, then you're kind of stuck, right? Because you could have a great credit score, but if you have no assets, that's difficult. And then if your income's not too high, then you might want to consider adding another person to the application, like a spouse. And that's why I say, like, sometimes you say the thing about, well, you know, my wife is going to buy on her own and I'm going to buy on my own. And that works for some people depending on their income and where they're buying. It doesn't always work for everyone. That's why I say do the thing that works for you, because if you've bought nothing, you have more to lose than if you bought something, even if it's not the exact idea of what you had in mind originally.
Gotcha. So then how do lenders, how do banks use income from your first property to qualify you
Thank you. That was the
from your
third
second
question.
property?
So now you have a history of rental income, and hopefully that history of rental income is on your taxes.
If I own a single family home,
Okay, better question.
Yeah.
I'm like ChatGPT. You got to get real specific.
my bad. If I own a single family home, how do you as the bank qualify me to purchase my second home?
Yes. So if you have a single family home and you plan to move out of that home, right? You're buying another primary residence that you're going to move into. We now need to ask for an executed lease of that property.
Of the single family
Of the
home
single
where you're
family
at.
home.
Okay.
We need to see first and last deposit at minimum. And that means your tenant, your future tenant, not only are they executing that lease with you, but they're also giving you those checks for deposits before you're
Or
closing.
cash.
No cash.
No cash.
No cash, because
checks.
you cannot verify cash. You can verify funds that are made through a wire. You can
Yeah.
verify funds that are written in a check, even a money order, but you cannot verify cash.
You said primary residence. If that single family home, can I still use 5% down to buy a you probably answered this, a non-primary residence property? Or does it have to be more percentage down?
It has to be more money down because it's no longer your
Gotcha.
primary residence. It's an investment property.
All right. So if
So
I
if
want to
you're-
buy that second property,
Yeah.
either I'm going to stay where I am
Right.
and buy that second property with a higher down payment,
Right.
probably 15.
You can do, depending on the type of property. So if it's a single family or condo, you can do 15% down.
Mhm.
If it's a multi-unit, you can do 20 to 30% down.
20, 30% down.
Yeah.
Okay. And then now if I want to leave this single family home and move to that other property, then I can utilize
you
the
could-
5% down.
Yeah, 5 or 3.5% down if
5
you're
or
using FHA.
Gotcha.
Correct. Yeah.
Okay, that makes sense.
Yeah.
Now, so we talked about a lot.
We did. What time is it?
No. If we could now just do like a high level overview of, all right, I got my property. What's the next step to get the second house? And
I would say
1, 2, 3, 4.
what is always smart is to keep the communication open with your real estate team,
Okay.
with your loan officer, and with your real estate agent. Because if we know your plans, we can keep a tickler kind of file for you and give you a call. Like if you said to me in 6 months, I think I want to start getting ready, considering of like what it would look like for me to buy again. Now, I mean, most people, if they're good, like we are, they're going to call that client. They're going to check in on them pretty often. So even if you don't tell them, they'll know. They'll figure it out with you as the time goes. But what you do then is you put a plan in place and you do another review, including those debts. Most people buy a house. They probably have to do some fixtures. They probably spend a little money. Maybe their credit card debt increases, whatever, So we want to do another full review, just like when you were buying that first one. So we're going to do a soft credit pull. We're going to do the pre-approval. Yep. If we have your application, we can copy the old one and start again. But, pay stubs, W-2s, if you're a business owner, your last 2 years tax returns, if we don't already have them, right? And then we can look at the numbers, including that debt that you already have with the home that you bought. So if you own 3 properties, again, we're going to use a certain percentage of the income, but it's going to be based off of what you're reporting, right? Okay. So if you buy the multi-unit house and it's not a single family, are you showing rents? And it actually helps you to buy the multi-unit when you're doing the other, and if you're doing another investment purchase, because now you are an experienced investor.
Okay. All right. So I have my first house and now I want to go buy the second house. So I go to my lender. I say, I want to go buy my second house. They're like, okay, you have equity in your home. You want to use some of that equity to purchase your next property.
Right.
And the only way that I determine if I have that equity in my home is either through my real estate agent, but really through you.
A combination of both too, because I like to partner up with the agent and say, why don't you call Darnell and get him to give you a CMA, right?
A comparative market analysis, which basically just says, hey, your house can sell for X amount of dollars right now if it was
based
on the
most current sales in the area,
and it might be worth properties around this amount.
Right, exactly. Because that helps. Because when we're doing an equity, most equities are doing what some people like to call a drive-by appraisal, which is really mostly based on public data that's listed online, and we use that kind of drive-by appraisal is really just they drive by to make sure the house isn't vacant, burnt, or whatever. And then we use the data from the comparable sales to determine a value. That value isn't always as high as you'd like it to be. So some of the borrowers, what they do is they request an actual physical full appraisal. They pay a fee for it.
So not what Zillow says or Redfin.
Exactly. So
I
now
pay the bank. They send out an appraiser.
Exactly. They send out an appraiser. The person goes out to your house just like when you were buying it. They review everything. They're going to look at any improvements you've made. So again, that one can be probably better because the online one has data from when you bought the house. It doesn't have the data that shows, you got brand new countertops, you did the floors in the kitchen and the bathroom over. It doesn't have any of that data. And FYI, replacing a water heater does not bring value to your home. No. It might bring value to a future buyer or to you, but it doesn't add value to your home. What adds value is, doing a bathroom over, doing a kitchen over, doing the floors over. Those are the things that add most value to your home. And obviously, of course, always adding more living space. That always is helpful.
So then, okay. All right. So now I got the first house. I spoke to you.
Yep. We did the equity.
We did the equity.
We approved you.
We approved me. So now I go shopping.
Now you go shopping because you'll have a pre-approval. You've got the equity all done. The equity is its own process, right? So that's something.
Equity is what? In layman terms.
In layman terms, it's another loan against your home. So there is a closing that happens.
And I'm sitting on equity. So that means my house I bought the house for $100,000.
Here we go.
And it's increasing equity.
Yeah. So now you can take out.
It's increasing value. I'm sorry.
Right. It's increased in value. So
to
now
$300,000.
You're taking out the difference between what you owe, what the bank will allow you to go up to, right? Because it's probably not going to let you go up to 100%. even though there are some online lenders that do that, I have seen them. I've seen some of my clients use them and it works well for them, but it's a little risky to use up to 100% of your home's value because, you know, if you had to sell it on a quickie or whatever, economy changes, it's just a little dangerous. So most places are only allowing you up to 80 or 85% of your home's value, meaning in how much you can take out, and then you deduct whatever you owe for that first mortgage, and what you have left is the equity. So let's say that the equity is $100,000, right?
Yep.
You use that $100,000 to now move forward and buy that other property.
Okay. And obviously, for the most part, I'm not buying a property outright.
Right. You're not. You're
I'm
getting
just
another
using that
loan
$100,000
as a down payment.
Down payment. And how much should I have? Because I assume that there's closing costs still.
They're still closed for the equity?
No. Well, is there for the
so
equity?
Some equities have closing costs that can be up to, you know, I've seen some all the way up to like 4% of whatever you're borrowing. And then I've seen others that are much smaller fees. They're only charging closing cost. So if, you know, the equity closing costs are, I don't know, $1,500, that's what they're charging you.
Okay.
They all vary. So obviously you're going to get disclosures, review them, ask questions. Equities are based on prime rate. So make sure you're asking, is this prime plus what? Prime rate is on Google. You could search it yourself. So you'll know what the prime rate is, and you can determine whether or not, like, if you go to such and such bank and they're telling you the rate's 8%, but prime 6.5%, they're charging quite a bit of money to borrow. Right. So again, shop.
When? At what point then? When I go to you and ask for the HELOC?
Ask questions first. I always say ask questions first.
But
right?
I don't know what questions to ask. I'm just saying, hey, I want to buy a second home.
The question you're going to ask is, I want to buy a second home. We need to do the pre-approval with your lender, your trusted lender. That's going to tell you, this is how much you need. This is how much you have. You know, if I were in your shoes, I would get an equity line. They might be able to do the equity. Like someone like myself, I can do an equity. Some places can't do equities, so they send them to someone else. I have trusted relationships with local banks that I use that sometimes, depending on the situation, I will send my client to the local bank because it makes the most sense. I still want my client to be able to make money off that future purchase. So if I'm maxing out whatever the rate is on my end, or if my rate is not as attractive, I don't win anything if my client isn't winning. Does that make sense?
It does.
It's like they have to be able to make money off this purchase. So it's not just a transaction for me. That's just how I am. Not everyone works that way. So that's why you as the consumer need to make sure you're asking questions and that you're looking around. There's plenty of stuff online, but make phone calls, talk to an individual, you know. So
then I guess to really kind of put a bow on everything. Is that your first home is where you live, and your second home will be what builds you wealth.
Yeah. If your first home where you live is a multi-unit, you're creating wealth faster. So that's what I've learned from you.
So then really it's a mindset shift, right? Because if you do have a 2, 3, or 4 family home, you're already an investor.
Yeah.
You're already a landlord.
Yep.
So it's just about how you kind of think about things, that mindset shift.
And also remember, you can get a management company to manage for you if it's not something you're truly comfortable with.
Yeah. And, you know, and just another thought that I had is that getting your first property, it really doesn't matter which property it is. It could be a condo. It could be a single family house. It could be a multifamily house. Yeah. What's most important is that you just get in the game and get something. Because I've seen my own clients have condos, a 1-bedroom condo in the middle of Brockton. And he utilized that property to go buy a nice single family home in the suburbs while renting out that condo in Brockton. Yeah. And, you know, it's paid off, and it makes some money every month. Yeah. And all he has to pay is his condo fee. Right. And I've seen other clients use their first house, and then they either sell it or they'll hold it, rent it out, take out the equity, and go buy another property. And then you just rinse and repeat over and over again, right? Yeah. So there's no set amount of times that you can use conventional financing to go buy another property. Well, the maximum amount of conventional loans that you can have, conventional financing that you can have,
on properties is 5. After 5, you're considered commercial.
Oh.
Yes.
So that's another topic.
That's another topic that we can talk about next time. So with that said, I hope you learned a lot from what we discussed today.
Yes. I've learned that your first home is where you live and your second property is what builds you wealth.
Yeah, I agree. And also, there's no wrong way to start. If you're going to start, like sometimes I get people that say like, call the loan officer, call the agent. Like, it doesn't matter if you call them or myself first. We're always going to revert you back to each other. It depends on the timeline, right?
Correct.
Because when I sit with someone, I say, are you working with someone? Who are you working with? If they say no one, I can say I can recommend you someone. And legally, both of us have to recommend you 3 people, right?
Sure.
Yeah. It, legally, that's how it works.
Mm-hmm.
So if you've already started working with an agent and they recommend you and you speak to the 3 lenders and then you pick me, I mean, I'm going to give you the best service. But
So most importantly, doesn't matter. Just get in the game, get your property, and once you get your property, then get another property.
Yes. Don't get stagnant. And just because the numbers don't work right away doesn't mean that you can't put a plan in place to make them work in the future.
And I think what makes a lot of people scared is that they don't have the money to buy that second home without realizing that they're already sitting on money through the equity in their house.
Yeah,
that
absolutely.
they can pull, like a bank, pull money out of the bank and use that to go purchase the second house.
Yeah.
All right. Well, that's all, folks.
Thank you, Darnell.
Thank you, Catherine.
You're welcome. Thank you, producer.